Hey, what's up, everyone? Welcome to another episode of the BYOB Money School Money Multiplier. Ask Me Anything Happy Hour. Happy to be here. It's Wednesday, July 29th. We're here to answer any questions that you have around infinite banking, becoming your own bank, and whatever else we can get into today. So appreciate you being here. Put your comments in the chat box. Put your questions in the chat box, and we'll get this show fired up here shortly. We'll do some introductions like normal and get rocking and rolling. Let's play this quick little intro video and we'll get to it. All right, welcome back to Ask Me Anything by the BYOB Money School team. My name's Stephen Nagy. I'll be here with you for a little bit. I do got to sneak out early today. We have a chamber event going on here at 5 o'clock, so I'm going to shoot over and hang out with some other local business owners and chat and maybe have a little happy hour myself. But with that being said, I'll turn it down to Smiling Tess. What's up, Tess?
Oh, did he freeze?
You're frozen? You're there.
First, you were. Or maybe I was frozen.
What's up, Tess?
Good. Hello, everybody. I guess I'll start. Hello, I'm from the Detroit area, and our big news this week is we officially have a new bridge out of Detroit. The Gordie Howe opened up yesterday. And for those that are talking about what do we drink, I have 64 ounces of something, and I'm not going to tell you what it is.
Whoa.
And now we'll go to, let's really mix it up. Let's go over to Brian. Uh-oh, he's muted.
Oh, he's muted. There we go. Is it working now?
Yeah.
It's working now. That always works. Hey, everybody. Brian Foucher up in North Idaho. And it's kind of interesting. I've had a common question here the last few calls I've had, and it was, how long have I been doing infinite banking, or when did I first get into it? So actually, I looked back, and I first got into infinite banking 14 years ago. So that was my first kind of policy way back then. And then my first webinar teaching infinite banking was 10 years ago when I built a webinar and also a training course on infinite banking. So it's been quite some time, almost over 10 years I've been doing infinite banking. So I realize it's been a long time, been a really fun journey, and learned a lot along the way, and happy to share what I've learned with you all. But with that, let's go down to Jason.
Hello from the city beautiful. Always happy to be here. Always happy to answer questions. How long have we been doing this, Nagy? Has it been like 3 years, 4 years now?
Since COVID, man. So I don't know. It's been a while.
When was that? For real? Like, when was that? It's a long time. 6 years already?
6 years ago.
Wow.
Yeah, 6 years.
I've not been here that long, but I feel like I've been here forever. So happy to be back. Ask us questions. Always happy to be with my peers and fellow practitioners. And yeah, I mean, here's a secret for all of you. It's not about what you know. It's about what you do. What action are you taking?
Love that.
Linus.
Hey, everyone. Hey, everyone. Linus Nolt here from Hopkinsville, Kentucky. Like I always say, just another hot day here in Western Kentucky. Need to be out at the lake, really. But I'm helping tons of people, so I'm having fun and happy to help here in any way I can to answer any questions, give any insights, things like that. I'm excited to go attend an event done by one of the insurance companies we work with next week. So mingle with others and learn more things and see how we can help people better and more people too. So let's get into some questions.
Yeah,
that's right, man. You guys, all three of you, Jason, Tess, and Linus, will all be away next week. So Fouts, it'll be you and me. Maybe we'll invite a couple others on, but we won't be here. Don't worry. Next week, same time, same place, just as the last 6 years. All right, cool. We got a question to start us off.
Yeah.
So we got a boo. You suck. I like it.
Yeah. It says infinite banking. I don't know a lot about this, but is there an age where it doesn't make sense? So that actually was answered on Wealth Wednesday today as well.
Mm-hmm.
So who wants to take that one? Anyone?
I say Linus. You knew I was going there.
I'm going to say 0 to 75 makes sense. So if you're outside of that, there's maybe other options for you. But as far as an infinite banking style policy on you, those are the age ranges that can work, assuming good health. But it is also possible for you to get policies on other people. So that's something to look into. We will drop the link where you can actually schedule a call with one of us to explore your specific scenario. So be on the lookout for that in the chat.
Yep. It is not too late. You're thinking it's too late. I should have started this 20 years ago. It's about the second most common thing we hear. So I say this all the time, but if you're in your 50s, you're at halftime. So your 30s are the first quarter, your 40s are the second quarter, 60s, third quarter, 70s, 75, fourth quarter.
And then we have the unique animals like Steven, who's going to live to be 150.
That's right.
Yeah.
That is a frightening thought.
Right back at you, Shelby.
And then, well, let's go to this question first, because this one is actually, in addition to the one he just asked. He's asking, can you explain how it still works at 65 to age 75? So, I mean, the way I always explain this, I'll take this one, is that as you get older, the cost of the death benefit just goes up. So the way that it works when you're older is, to be honest, you've got to put a bit more towards the premium to get the same results as when you're 30 years old. But it can still function. It's just a bit more premium that has to go into the policy to have more, foundation to support what you're going to do. But I mean, it still works the same way, to be honest. It works the same way at age 75, at age 30, but the numbers just might be slightly different. So
how about just a shorter runway? That's how I would describe what Brian just said. You have a shorter runway when you're starting later. That's all. You don't have as much time to capitalize your system, put as much in. So you might want to overcapitalize later to get it going faster.
Yeah. Also, one thing I'll say about, the age. So we work with multiple companies, and there's a reason for that. It's because not every company is a fit for every client. So if you're age 70, and I'll just be honest, there's one company A, by the way, that I would not go to because it just will not work. But company L, I would go to that company because it'll work a lot better at age 65 to age 75. So that's something that makes us a little bit different than maybe other practitioners, is that we work with other companies, multiples, because we know not every client is going to be the same. So we don't want to limit ourselves to just one company, one product, things like that. And I say this because it came up, actually, it was yesterday. I had a client that had an agent, infinite banking practitioner, set up a policy with a company that we work with. And then I explained to that client, we work with that company. We are their largest broker. And then we went through a whole thing, and he ended up saying, hey, Brian, I talked to him. I liked him. I talked to you. I'm definitely going to go with you guys because you actually, I asked you a question. I asked him, and he said, I don't know, and I don't know. And yet you answered every single question and a lot more. And he could not answer these questions. And I'll be honest, they were complicated questions, but the other agent just said, I don't know. And that was kind of, I was like, oh, I've heard that before. But that's why we work with more than one company. So
that's why we call you Brain Foots.
That was a fun. That was actually a recorded call too, and I want to go back and look at it because I want to go see what the questions were. But there are ones that all of us here on this call have heard before. We've all heard it before, But it was interesting. And the other agent couldn't explain some aspects of the actual illustration that he built, like the certain features inside of it. I'm like, oh my gosh! I mean, that's crazy to me. So. All right, Paul Harder has a good question here. It says, when is interest on loans calculated, on the policy renewal date or a year after the loan is first taken out? Neither, by the way, but who wants to
take that? It is calculated on the policy renewal date, but it's going to be on the daily balance.
Right.
It's calculated daily, but as far as when it's actually calculated and charged, is going to be on the policy renewal date, unless you are paying off the loan entirely at some point before then obviously they would be calculating at that point and including it in the payoff figure.
Yeah, I always say that the way I always explain it is they calculate it daily, but apply it to the policy loan at the renewal date.
Yeah.
That's the simplest way to explain it. So that's a good question, though. Let's see here. All right. What are the biggest financial benefits using infinite banking?
Ooh, that depends on you and what you consider the most important.
Yeah. Tess is yelling over that, I think.
I'm thinking the biggest number, obviously, it's the death benefit, because we are using life insurance policies for the infinite banking concept. So the death benefit is the biggest number involved, but it depends what's important for you. Obviously, these things are being, well, if you know this much about infinite banking, these policies are built for high early cash value for you to be able to access and use for the but it's certainly not the only ones.
Yeah. My presentations, because I list them all out and saying most financial instruments have one or two of these benefits. Infinite banking has every single one. And that's what makes it, unique. And so it might not be one benefit that makes you want to do infinite banking. It might be two or three of those things. But I mean, I like that one, but also the one is guaranteed compound growth for the rest of your life.
Mm-hmm.
Yeah.
Like there's very few things that allow you to have that at the exact same time you're using that same money to go do other things in your life, such as investing or building wealth or paying down debt. But you have that guaranteed growth for the rest of your life. So that's one benefit. There's about three more.
Death benefit, definitely.
Well, death benefit in that one. I mean, I always say protection of your capital.
Yeah.
So because in most states, these are a protected asset, state specific, keep that in mind. It privatizes your money. That's one of the things I love, that it privatizes it. Whereas like banks, 401ks, stocks and bonds are all private strategies, meaning they're open to public knowledge essentially. Whereas this privatizes your money. So that's another one. And there's one other main one. Who wants to guess what it is?
Definitely shouldn't be guessing.
I'm trying to remember which ones were said.
For me, it's control. The other biggest financial thing is that you control your money today, tomorrow, and down the road versus having the IRS control it, Wall Street control it, your 401k provider controlling it, your employer controlling it. You're the one in control. So you're in the driver's seat. And that is one of the biggest benefits, I believe, of infinite banking is you. You're in the driver's seat. Yeah, and these are all benefits, by the way. But once again, as Linda said, or Jason said, you might value one benefit more than somebody else might, and vice versa. So that's why we kind of explain all these benefits when we're talking with you, because there's a lot, and most people are not aware of every single one. So
the really cool thing about working with any of us and working with our team is we're not going to we know what the benefits are, but we're really focused on solving your problem.
Yeah.
It's like if you came, I've been using this all week, but if you you go to Home Depot and you start looking at drills and you're like, hey, I need a drill driver, I need a hammer drill, impact drill. And you're looking at all the drills, you see what goes through concrete, what can go through wood, what goes through metal. And then you're going week after week. And then the Home Depot assistant comes up and asks you, what are you building? And you're like, I don't know. It's not going to get you very far, right? You're not really going to know what tools you need. So that's why this is so fun, why it's called Infinite. But at the beginning, at the core of everything, it's really understanding what are you trying to accomplish first? And then where does that tie into your longer term vision over time? Your 3-year, your 10-year, your 15, 20, 30, 40, 50-year plan. So
I always say it's very hard to plan a long road trip if you don't know your destination.
Right.
How much time you got to take off work, how much gas you got to budget, where are you stopping and staying overnight, all this kind of things. If you don't know where you're going, it's really hard to plan. So yes, same with infinite banking. Know your destination, and then you can plan it better.
Yeah, the biggest benefits are in the strategy itself, how you actually use the concept. But let me take like a minute or two to talk about one other benefit of the policy itself, because most policies are going to have this benefit included for no additional premium. So it's a chronic illness rider and a terminal illness rider. It's not always included, like in the case of a super small policy, or in the case of sometimes a table rated policy won't have one of those riders. But it's just come up as something really important this past week. I had a client that I just discovered recently that for the past several months, his health has gone downhill very, very fast, like developing dementia and a lot of other complicating factors with it. And so we determined he actually already qualifies for a big advance of his death benefit under that chronic illness rider, simply because he's not able to perform 2 out of the 6 ADLs, activities of daily living. And so it's a sad deal. This is a father and grandfather. He's only 56, but it's really cool to see that this was in place to help with alternative treatments, to support the family, carry the living expenses, the mortgage payments and things like that while they're going through this. Because it's also not really sure how much longer he will be here. But, if that time comes as well, or when that time comes as well, then the policy has a large death benefit to come in as well. So it's just cool that he had that in place. It's not even been 2 years, but it's a significant benefit that we tend to overlook because we are focusing on the design for cash value and how you're going to use it for infinite banking, but there is more to it.
Yeah.
Yep, 100%. All right. Yeah. It's funny. Kathy says, I misspelled Brian's name as Brain. It happens a lot. It's happened throughout my entire life. In fact, autocorrect will oftentimes do that. So Brain Foods is my nickname.
There you go. Not a bad nickname.
Nope. So Jaybirdfly says, what is the lowest possible payment? When you say payment, you're referring to premium deposit, by the way.
Yeah.
One could make on an infinite banking policy at age 60. I've had one quote where they said 1,200 would be the minimum to make it work. That's not accurate. No. It depends on what you're trying to accomplish, to be honest. So there's a minimum, but is the minimum the best for you? We don't know until we talk with you. That might not be what we'd recommend. We might say, well, 600, 10 times your age could be the minimum. But if you're trying to accomplish X, Y, and Z, it might not be 600. It might be 800 or 1,000 per month. Depends on your finances. Depends on, other things you're doing in life financially. There's a lot of factors that go into that, but the general rule of thumb is 10 times your age per month is the minimum, but is not the recommended per se. That's how I explain it. So to tag on to this one for our team here, how many times have people said, Chris said the minimum is 10 times your age per month, so that's what I'm going to be doing?
Yeah, Chris wouldn't like me for this, but I say that Chris guy, sometimes, he's not in these calls. He might not know exactly what your situation is. And that's not really advice that's going to help you. And I can tell you a funny story on that. Like I had a guy come in making $500,000, 36 years old, $300,000 in bad debt. I've told it before, but every toy you can imagine that a guy would want, right? Motorcycles, 4Runners, boats, RVs, everything, like guns, everything, probably flamethrowers. And he's like, yeah, I want to put in $360 a month to pay off my debt. I was like, cool, do the math. Tell me how long that's going to take. It was like 80 plus years. Right. So it has to be relevant to where you are. And Jay, I've talked a number of times, and I apologize. I have your email here, but it seems like we're going around in circles with the same question. So like, if I have your permission to kind of coach you live, it's really getting started is the most important thing. It's getting started with whatever you're saving. And if you're not saving at least 10%, then finding a way to make that happen, whether you're going out and making more money or you're looking at what you're spending in your lifestyle and saying, oh, well, this doesn't really align where I want to go. Like I'd rather have more protection. I want to have this freedom in 3 years. Like just ask yourself, hey, if I keep coming back to the AMA for the next 3 years and I don't change anything, like, how are you going to feel about that?
Yeah. Time lost.
Right.
No,
like that.
Go ahead.
No, I was gonna say that's how it guides you, Jay. So like there's not a right number for you. It's getting started. But there is going to be a number that makes the most sense based on your situation. And now it's been probably almost 6 months since we last connected. So I don't know if you're earning more, less, what's changed. But with some of that information, we can definitely dial it in. I can't just give you like a random, like, hey, it's $1,200 a month, $1,500 a month. It depends on what you're trying to do and what is available to you. So,
and an agency that's saying, $1,200 per month, we'd have to see kind of what they're trying to build, because they might be not doing infinite banking. They might be doing a higher commission structured policy. We just don't know. And also the last thing I'll mention on this one, Chris is not saying that you should do 10 times your age per month. What he's saying is to make this function infinite banking, you can't do less than 10 times your age per month, because then it will not function very well as infinite banking. That's really what that means. It's not saying this is what you have to do. Okay, and then so Kathleen is asking, saying, oh yeah, so celebrating our 1 year policy anniversary this month. That's awesome.
Ooh,
I remember
nice.
that. We went
better and better every year. Factually, gets better and better.
They went with an annual premium and are very excited for year 2. So that's awesome. Yeah, and I know the word, Kathleen, I think we have to hop on another call regarding your the annuity thing too whenever you're ready. We're talking through that as well. So Dex is saying, and Dex knows probably the answer to his question.
He does know the answer.
So if you pay off a loan prior to renewal, you're not charged interest. So obviously that's not the case. Let's say, just say that if you took the maximum out and then paid it prior to the renewal on yearly policies. What he's saying is, let's say you borrow $10,000 at the very beginning of the policy, and then 8 months later, pay off that $10,000 loan as an example. Are you charged interest at the end of the 12 months? So who wants to answer that question?
You're not charged it at the end of the 12 months. You were already charged it as the part of the full payoff you did at the 8 months in that example. So yeah, you were charged interest, but only for however long the balance was actually outstanding, not for the whole year, because you didn't have a balance the whole year.
Right.
Now, here's the question. What if you borrow $10,000 and then it's 8 months later, pay off $9,500? When do they charge the interest?
You're going to get an interest charge at the end of the policy year. It's going to be less than what if you had left the whole balance the whole year, because it dropped a whole lot. Yep.
So I've experimented with that before, and I always tell people, hey, if you don't want to do the interest in the middle of the year and just wait till the end, don't pay the entire loan off. You leave a little bit of loan there, and they won't do it usually. So it's kind of a weird thing. And I've played around with it before to test it out and see what they do, but it's kind of fun to have. Yeah.
Every carrier handles it differently, though, too.
Yeah. That's the one thing to keep in mind. So with how they calculate loan and when they charge it, it's actually carrier specific. Every company's slightly different at how they do it. But yeah. See here. So this says, in that case, he's ill. What's he referring to?
Oh, he's talking to referring to what I was saying about a guy that qualifies for the chronic illness rider. Dexter, he does continue to get charged the premiums and have to pay the premiums to keep the policy current. There is a rider out there that's available for an additional charge with any policies. We typically don't include it because of the extra charge, but it's called a waiver of premium rider, where if somebody was to become disabled or ill where they can't work and whatnot, where that rider makes the company pay the premium on your behalf if you qualify under that rider. But we don't include it because it does come at a pretty significant cost.
Yeah.
That's not necessary for infinite banking, so doesn't apply here. Premiums will continue to be due, and I was speaking with the guy's wife about how they're going to handle the next annual premium and kind of what the minimums are to keep it alive and whatnot for now. And of course we talked about next steps of applying for a payout under this chronic illness rider, since he qualifies for it. Or he will qualify for it in a couple months. Generally, there has to be the conditions have to be met for a period of time, like say 6 months, before they can consider a payout. So,
yeah, company specific too on that one.
It's a bit of a fluid situation, but I'm here to help.
Yeah, and the other thing too, I've had people talk about is they'll use the actual what they get out of the policy to fund the policy. So, which is actually why the loans exist, to be honest. So actually, on one scenario on something like this, if you have to wait, say 3 months to get that death benefit out, borrow from the policy to maintain the premiums if you have to get that lump sum, and then take care of yourself. So
yeah, it brings up a good point where when you're doing infinite banking, you want to keep a reserve and still be prepared for emergencies. This hit this family kind of at a unfortunate time where they had deployed all of their capital into an investment of some kind, where they don't have any loan availability right now. Now their next annual premium is not due until January and March or something like that. So it's right close, but it is tight. They don't have any extra liquidity, so that's not great. That's a lesson for all of us to keep some reserves on hand for emergencies. Have a little bit of a cushion.
Absolutely. This is for Jason. So so he wants to get a new policy. Awesome. He has an IBC policy for a couple of years with an older small policy.
It's a whole life policy.
Is it?
Yeah, it's an old whole life policy.
So it sounds like it probably was not an infinite banking policy structure, but
no, but it has some cash value and things.
Yeah,
so.
but all whole life policies will get cash value eventually, even if they're not designed focusing on it. So
And sometimes it's faster than you think, actually. Like a lot of people think, oh, this is awful. It's, just regular old whole life. It's like, well, typically 3-4 years into it, it starts having a decent amount of cash value. So just not much for the first couple of years.
It just takes some more time for it to be efficient too.
Again, depends on what your goals are, right, Brian? It depends on what your goals are, what you're trying to do. There's all kinds of reasons to all kinds of designs. So,
So Southern says, explain high early cash value. We call that HEC V, by the way, whole life insurance. And is it better than the insurance policies that you guys offer? Well, funny enough, what we do is HEC V. So they're one and the same. So that's exactly what we do, which are high early cash value policies. HEC Vs. By the way, the HEC V is a term that one insurance company coined that phrase, but we use it kind of generally to say that, hey, our policies, as designed, cash value within 30 days, not 3 years, not 5 years, not 10 years. It's within 30 days, regardless of how you fund it in most cases. Now, there you go. Could elaborate on that a bit more, but that's a simple answer right there. I always tell people, if somebody says, my agent says cash value within 3 years, and you want to do infinite banking, run away.
Yeah, exactly.
That's fair. That's fair.
Yeah.
I had a guy yesterday that had an engineer, Brian. You guys, everyone here would enjoy that call. He's like, yeah, everywhere I went, and he was shopping. I'm like, everywhere I went, the highest that you get me is 85%. And I was like, well, that's nuts. Like that doesn't make any sense because of what you're telling me. He had plenty of resources. Guys say 50% of what he made and wanted to put a heck of a lot in. So whoever's engineering was definitely engineering it because, hey, well, let's give them 85% and have a decent commission too. Or they really didn't know what they were doing. Because we literally had 92% commission with a healthy base or access. 92% access is what we're trying to say. Yeah, big difference. And from there, it was year 3. It was efficient. He could put a lot into it over the next couple of years. The thing was actually pretty nuts. And so by the time I left, he was blown away at what is possible when you start really delving in and tweaking things and getting to something that's personalized for you. So again, he had a lot of resources though. So he wasn't coming in and be like, hey, I have $500, give me 90%, right? It was like, no, I've got this much and I want this much so I can do this and pay off our house that's in a historic district as fast as possible. So,
yep. All right, I think that's all the questions we have in the comments. So if you guys got any more, put them in there. But there's a question here that I thought was pretty interesting. So on the Wealth Wednesday webinar, we were talking about how banks own more whole life insurance than they do their buildings and real estate combined. And someone asked here, and then when we put in this data here, or Craig did, and he goes, U.S. Bank owns over $200 billion in bank-owned life insurance called BOLI. And a recent market report said that they have a total surrender value between 202 and 226 billion. So if you do the math there, that means that they have 200 billion of life insurance that they have acquired, but it's worth 226 billion, which means they've had 26 billion of growth.
Yeah.
That's money that they made off of this infinite banking. But the question the person was asking is, who are they insuring for that amount of money?
Everybody they can, man. Everybody they can.
Yeah,
Yes.
that's why everybody's a VP. You have VP of every single thing you could possibly do at a bank. So
who they're insuring, it's a version of key employee insurance, because the insurance company, if they have a manager that manages this branch and that manager dies, then that branch is going to be in trouble because now they got to go find a qualified person, etc., and it's going to cost them time and money to go find someone else to replace that manager. So the insurance or the bank has insurable interest on the bank manager so they can get a policy on that person. That's essentially what they're doing, but they're doing it on, as Linda said, pretty much as many people as possible because they understand all the benefits of this.
Those would be some of the smaller policies they taken out is on individual branch managers and a VP of this and a VP of that in that branch. But you can go bigger, you've got the regional managers. There's more on those guys, right? So they can take bigger policies on those guys and gals, I should say. And then you have VP of marketing nationwide. You have VP of this and that and the other. You have massive executive teams and branches. Of course, there's a policy in every one of them. And I would assume they have a CEO and a COO and all this other stuff. Sure, there's huge policies on those as well. There has to be, for continuity and everything else. There's a lot.
Think of it this way. So you have a regional bank manager of a region making, let's just say, $2 million base salary, something like that a year, plus bonuses, $2 million. That bank manager, if they're in their 40s, can get $40 million of death benefit. Think about how much cash value will be in that policy over time.
Yeah.
Staggering numbers. So yeah, it's pretty interesting how they can do that. And we gave the example of Jim Harbaugh as an example, all that stuff. But it's kind of funny. People ask, well, why would the banks want to do this, or why would the college and Jim Harbaugh do this? Well, they got to give them that money anyways as a bonus or as a salary, so they do it through life insurance, because they know that $1 on that person is going to turn into $5 to $10 guaranteed via the death benefit down the road. So the bank is going to get their money back times a multiple. They're actually doing this because they know that it's going to make them a lot of money. So, and also
it gives them more control, it gives them more liquidity, it protects them from creditors. It does all the same things, right? Like, it's still privatized. It's just bank owned instead.
Yep.
And Brian, before you said U.S. Bank, and I thought you were saying like the branch U.S. Bank, like Bank of America. You were saying all U.S. banks, right? Because it's like 200 and I was going to say the number in 2024 was like 225 billion, and they have something like 12x the amount they've bought since 2012 or something like that. And I just found it was called U.S. Banks by Location, bank-owned life insurance. And literally, as I scrolled down while you were sharing, I got down to 2,892 banks with bank-owned life insurance in the U.S.
Yep,
that's a lot.
I believe it's got to be more than that. Banks are so big; they have so much money. It's got to be more than that. But once again, you don't quite always know exactly. Even
we're talking like Bank of America has 25 billion, right? Wells Fargo 19 billion, JP Morgan 12 billion, PNC Bank 11 billion. But I mean, so that's the top 4, and then you go down to 2,900 plus. So I mean, we're just talking. There's a lot.
Yeah, and I've actually proven it too, by the way. So I've proven this out because I had a client one time that was doing a financial presentation to his local credit union. I can't remember what the topic was, but I told him, I said, hey, before you start the presentation, just do a general question. How many people in the room have life insurance that is provided by, or that is on them by the bank, the credit union? And these are all managers and executives. And he asked the question, they all raised their hand.
Yeah.
So the bank has BOLI, which is bank-owned life insurance, on all of them. So it's he was kind of blown. He's like, oh man, you're right. They all said yes.
Yeah, here on this list, I just had AI added up for me. 2,893 life insurance assets valued at 210 billion. So,
oh my goodness.
I recently looked up my small local bank, or 2 banks, small local banks on that list. And I was like, dude, yeah, this one's got like 2.3 million in life insurance assets. And it's a very small bank. They have maybe half a dozen branches. And then the other one has 2 or 3 branches. And I think they had like $750,000 in life insurance assets. I'm like, yep.
Pretty crazy. All right, Dex is asking, I assume if they quit, they continue to pay premium. So referring to the employee, I don't know. I mean, who pays the premium, the bank or the employee? Because I don't really know the exact answer. Linus, maybe you do. There's usually an agreement between the bank and the employee as to how that's all handled, because that is an asset. And if the bank is funding it, it's the bank's asset, but there's probably a shared agreement. Like Jim Harbaugh, I guarantee you there's a contract between him and the college.
That's different than a lot of that's more specific and engineered with him understanding what's happening. My experience hasn't been a lot, but the folks I've talked to who are managers or VPs at banks who might have it on their body, they have no idea how it works. They're not involved with it. They're not doing it. So I almost feel like it's part of their just overall package. They're signing things. They're not understanding what it is. So I don't know that to be true. I'm just saying from my experience, that is what I kind of perceived from talking to the individuals who are like, yeah, I think I have life insurance through the bank. I'm like, I bet you do.
It's interesting because like, what if you work for the bank and you have a big policy they get on you that eats into the death benefit that person can get on their body? If they leave that company and want to get a policy on their own, if they have a bunch through the bank, then they can't get a policy because they're overinsured all of a sudden. Once again, that's a very different structure. So we don't know all the ins and outs of it, but it is kind of interesting how they do that. I've heard from somebody, I don't remember who it was, and this was years ago, that the beneficiary of those policies, yes, is the bank, but they also will sometimes bring in the family so that the employee is getting some benefit as well. So death benefit of 20 million, maybe 5 goes to the family and 15 goes to the bank. I mean, I don't know, but I've heard that that's how they structure it a little bit uniquely. But as Jason's saying, there's probably a lot more involved in how that agreement is put together. But I'd love to have a bank come and explain how they do it, but probably not going to happen.
I tried. I asked my local bank president. He did not want to talk about it, man. He did not want to talk about it. He wanted to deny it entirely at first. Really? And I really kind of pressed him. And he finally gave in and said, like, there's a type of asset in that category, but it's not life insurance like you would know it. I'm like, yeah, I'm done here.
Yeah, that's funny. That's awesome. Southern is asking another question here. It says, is there a whole life policy that allows investments into precious metals or stocks inside the policy? Yeah, kind of, but no. I'm going to say no to that one. Even if it's an IUL, I'm going to say no, because your money is not directly invested into that stock or that thing. The returns are based on it. It's kind of a weird deal. The only thing I'm aware of, Linus, you probably know better than I would even on this one, is the what's that? The premium fund, where you put your premiums in ahead of time and it goes into a fund that gets returned based upon a certain index.
And that's just going to be a rate set by the company. It's not set by any specific investment either. It's just kind of like an interest-bearing checking account.
Yeah. But I mean, honestly, to be honest, Southern, like, I wouldn't want that to occur, because an investment involves risk. And the whole purpose of infinite banking and whole life is to not have the risk and volatility around your money. So I don't want it around precious metals or stocks because they go up and down. I want it tied to the performance of an asset that has never lost money, has always been profitable, which is the insurance company itself, which is dividends, by the way. So
we're putting our money into whole life insurance, transferring the risk to the insurance carrier for them to take on investments and try to make the returns. And they're guaranteeing us a return plus dividends on top. So we're now out of the risk picture. They're having the risk. So this is how I look at it. And then there is a whole life product. I don't know if it's still in development or if it's available now, where the company itself is backed by Bitcoin primarily. I read about it a few places, and I haven't even really watched their whole presentation on how it works. It's not, the policies themselves are not or they're barely able to even be used for infinite banking. So I guess it's something new that's being explored out there. But when you're wanting to do infinite banking, it needs to be whole life, where you're on the guarantees and the risk is on the insurance company.
Exactly. Yeah. All right, Kathleen's got a good question here. It says, what was the biggest financial mistake each of you made? What's your lesson learned? And what would you suggest to anyone else facing a similar situation? I'll go first on that one.
Sure.
I gave my financial portfolio to a financial advisor. That was my number one mistake, and I lost over $500,000 in one fell swoop. Gone. My lesson learned on that is know what you're investing in and maintain as much control as humanly possible of your money. Because I gave up 100% control. The assets were still there, but I lost ownership of the assets because I didn't control them in the first place. His investment fund did, but when he blew up, all the assets were sucked into the whole thing, and I lost them all. So that was a huge wake-up call. And that gentleman also had set me up with an infinite banking policy that was a VUL. And so what that all kicked me off on was my whole financial journey. This is like over 10 years ago.
I was just thinking that, probably what a blessing that guy was to you. I mean, if he didn't do what he did to you, you wouldn't have gone down the rabbit hole and been here, right? So
maybe not. Nobody knows.
Yeah.
But that's what set me on the journey to learn how money works, because I was managing $180 million construction projects. I was the money guy, but I had no idea on how to manage my personal finances or how money worked. That's insane. How do you have control of that much money, which I did because I went to college for that, but not have an idea of how to manage $500,000 on my own money? Mind blowing. That's what college did to me, by the way. And so that's how I learned all about what I'm doing today, was because of that huge mistake. So knowledge about how money works is huge. Linus, how about you?
Real estate, man. I bought a property and I was going to do all the work myself. And I had a fair amount of experience, but then I started feeling like I was pressed for time. I hired a bunch of people and I tried to manage it all myself. And I thought I knew what I was doing. And I didn't really, I didn't bring in experienced real estate investors or trade professionals as much to try to help steer me in the right direction. And I ended up with way too much into the property, like spending more on it than what it was worth. So that, I would say, is my biggest financial mistake so far. And what I learned from it, it kind of goes back to not being afraid to ask other people for help or advice, I'd say, is one. So I guess getting around my ego on that one. And the other one would really be not spending borrowed money too freely. Because that's the other thing that was going on that ended me up in that wrong situation, which I'm still, fixing. What was the rest of the question? What would you suggest to anyone else facing a similar situation? I kind of covered that, I think.
I didn't answer that.
Yeah, get education.
And I think what I'll say is I'm going to actually kind of piggyback off of Brian's and agree with what he said about like financial advisors. One of the things I did do is I worked in the W-2 world up until a couple of years ago. And because I had left one job to another, I had moved a 401k in with a financial advisor. And it was the financial advisor that managed the 401k at the new company that I went to. But when I started learning about this process, I really realized how little control I had when I wanted to move the money into a self-directed IRA. It took me 6 weeks of fighting with the man and compliance being brought in before he ever released the funds. So that was kind of a learning lesson about how much more control he had than I did, because he kept looping me in a circle. I can't do that for you. You need the broker to do it. I can't do it. It needs to be the insurance company. I can't do it. So it turned into a circle where we had to bring compliance in. So that I didn't like, because I didn't have control. And the other thing I would say is, as a W-2 employee for my entire career, I should have had more monthly income coming in, because some of the, kind of back to what Linus was saying, some of the private lending deals didn't pan out. So it limited the amount of monthly income pretty quickly when the real estate deals weren't performing as expected. So we talk a lot about liquidity. So a lot of what we talk about in all of these sessions are things that many of us have faced firsthand. So we're not just tossing something out there that we haven't experienced. We've actually experienced it firsthand. We may not always go, hey, it was me.
Yeah, I guess what I would share here would be, and thank you everybody for sharing. I mean, it's hopefully someone's learning from this. Someone's picking up what mistakes we've made. I would say my biggest mistake was being a little bit desperate, looking for a solution as I was transitioning out of corporate America, not really knowing how to bridge the gap between what I was making in corporate America and what I was going to make going on my entrepreneurial journey. And so I actually took a loan, like kind of borrowed money, took it at 13.89%, put it into something, and that never came to fruition. 2 years of that money being tied up, me paying on that loan at that percentage. So it ended up costing me like $22,000 more than what I had even borrowed, because I never saw a cent. And so I did it from a point of being desperate, I guess, and then seeing and like convincing myself, looking at the numbers, looking at like the investment, going through, talking to other people who had been in the investment, and just convincing myself it was a good idea, because I was looking for a solution rather than really understanding it, knowing it, and being confident in that it was going to be a good thing. So
there we go. Love it. This is a good question that we get quite a bit. What do the insurance companies invest in their general fund?
It's a giant answer.
Yeah, I mean, there's a simple answer and a long answer. Every company is slightly different. And I know Linus
They're
was
pretty
at
similar, though. They're pretty
you were at
similar.
Security Mutual, and like they're a little bit different. But generally speaking, it's going to be corporate bonds, government bonds, real estate, and loans, policy loans. So that's some of the main things. And then like think about it, when you drive through downtown like a big city and you see like a stadium, what's on the front of that stadium? An insurance company's name, or a building might have an insurance company's name. So it's kind of interesting. Like a lot of the big companies that you see downtown on a building, they might rent the building, but they don't own the building. Insurance companies own a lot of big buildings, and their names are not on them. And so, I mean, Linus, what was Security Mutual's stuff? Do you remember theirs?
Oh yeah, very similar portfolio. Because of them being so supportive and even outspoken in support of IBC, they actually have a higher percentage of their portfolio in policy loans, which is interesting to see. Much higher percentage than most other carriers. But otherwise, yeah, quite similar. Generally, a carrier or these mutual companies' portfolios also include some loans, like the safest loans you can really have to large companies. So yeah, they invest very safe, very, very long term. And that's because they're taking on promises of a death benefit risk that can extend for say 10, 20 or 30 years long-term policy, and even way longer than that on a whole life policy. So they've got to invest with a very, very long-term horizon.
And those are really, because my background is in the finance department of insurance companies, they're really highly regulated too. Every single investment an insurance company has is rated by an organization called the SVO, Security Valuations Office. And so they're going to be really particular about what they're doing, because you've got to run it through these ratios, and it has to stay within a range, or you take a hit to your surplus. And if you take a hit to your surplus, it reduces the amount of premium you can write in the coming year. So it is really, they may have a slight percentage difference between what they're investing in, but they're all pretty similar because they all have to run through that same ratio review every year.
Well, also kind of a fun thing to ask is, well, what's the safest investment the insurance company is invested in, or most secure? The funny thing is actually is policy loans, because they're the one that has a guarantee tied to it, because the death benefit is guaranteed. And so the death benefit is the collateral against the loan, making the policy loans one of their safest investments. Not saying it's the best investment they have, but it's one of the most secure. It's kind of weird, but they talk about that because those don't provide cash flow all the time, and because they can't control the cash flow, the policyholder does by paying the loan back. But once again, though, it is the most collateralized that they have. So Dave's got a good question here. He's saying, if you have to take a policy loan to invest in real estate lending, and the real estate pays interest only for say 24 months, and then they return the capital at the end of the 24 months, do you make only interest payments back to the policy?
Sure, you can.
It depends.
Yeah.
It depends, but that's a good move. Like find a way to, because as you pay it back, you're uncollateralizing the loan. So you're filling up your capital to use it again. You're actually going to pay less in interest. You're actually increasing your margin on what you're earning on the real estate deal as well. And then when the money comes back, you can park it back into the policy until you have the next thing you're going to invest, and you can move the money again. So,
yeah. And it 100% depends on what you're trying to accomplish, because you can do it what Jason said, but let's say you have a bunch of bad debt like credit cards. Well, you might take that interest from that investment, instead of paying back your low interest policy loan, pay off high interest credit card debt. So it's just math, by the way, as far as I would go through with it, but it depends on your individual situation and what makes the most sense. Mm-hmm. What do you need that interest payment for?
Mm-hmm. Yeah, that's not Dave's situation, I think. But yeah, there's his follow-up there. He said policy interest rate is, say, 5% annual. Would you pay monthly just maybe 9% annualized back to the policy and then pay the principal back at the end of the 24 month? Yeah, even better, man. The more that you're able to pay back on that policy loan, the less you're spending in policy loan interest, the faster you're just reducing the balance. And what can be cool is if you pay extra on that, and then the lump sum comes in, and it's like, okay, it more than pays off the loan. So you got some extra to, whether it is to start another policy or to max out the room in your existing policies. Like,
Yep.
you end up having a surplus of more than you planned. So that's a great way, or that's a great thing to shoot for, is just to pay as much as you can, or as much as makes sense according to your current cash flow. And then maybe when the lump sum comes back in, you've got more to work with than you planned, and that's always good.
Yeah. And if you're in that situation, by the way, for anybody who's listening and you're saying, okay, what's the best thing to do? I'm not quite sure. What's the first thing you should do?
Get on the call with us.
Exactly. Call up your money mentor, call up your implementation specialist, call us up, and we'll run through that with you. We'll use even software to actually find out what is the best way to do it. But great question there, David. But great question, because that's a good problem to have.
Yes.
I would say create good problems and solve them, because that's fun. That's fun. All right. Well, we're down to the wire here. That's all the questions I see so far. So if you guys got any last minute ones, put it in the chat box. Otherwise, here we're gonna bid you adieu, or how do you say that?
And David and
All right.
June, we saw you in the Wealth Wednesday too, so it was great to have you here with us as well.
Yeah, come back next week. Bring a friend. We'll be here. Bring some new questions. Bring some old questions. Bring what you want to talk about, and maybe bring something that's key. If you haven't started, bring something that's keeping you stuck. Like, what's something that's keeping you stuck? Let us answer it for you. Let us, guide you on that. It'll be fun. So,
can you take
Thanks
out
for being
all
here.
the kids? Who put that in there? Who put that in?
Looks like you, Linus.
Yes, of course, you can take policies on kids within the guidelines of the insurance company. Did you have an answer for that, Linus, that you wanted to put in?
Can you, and why?
Oh, and okay.
Why? Okay, I wasn't sure what that was either.
I want to hear your responses.
I mean, I've done presentations on juvenile policies and why the wealthy do them. It's because when you start looking at the generational wealth aspect of infinite banking, it makes 100% sense to do policies on kids when they're born, because that's going to create that. It's going to take that money, call it $1, and turn it into 10 to 15x guaranteed tax-free for the next generation. So think of policies on kids like a tiny pebble on a big or snowball on a hill. It's going to turn into a massive one down the road with a very, very initial small amount of money. It is staggering. I got to go find that presentation, because I always talk about it. I got to go find it and share it, because it's just, the math is just insane. It just makes so much sense. But you're also setting them up and your future generations for, financial success. And so think of like planting that seed on a tree that's going to grow into a massive oak tree. It's going to be huge. It's going to be awesome. So.
Like Brian said, it's going to be awesome. Yeah, policies as soon as they're 15 days old.
Yeah.
Yep.
And it is kind of cool when you look at, like, there is the Vivi Lucky Jeans that Chris did, where a lot of the events of Vivi's life can be covered with her policy, whether it's college or whether it's a house or whether it's a wedding. And it has all that time to grow, and it's incredible.
No banks involved.
Yeah, there you go.
Yep.
Well, we did it. We made it through another one. So
yeah.
Thank you all for being here. Come back next week. And that's another Ask Me Anything. Anybody else got anything to say?
Take care, everybody. We'll see you next time.
See you.